ever presented and watch them at your convenience. So let's get moving on with chart patterns and interpretations. Now today in class, I'm going to use the term security, but I know I'm going to say euro. I know I'm going to say Bitcoin. I know I'm probably going to say Facebook, but I'm not talking about any specific asset. I'm talking about all assets that are traded in the financial markets in which an open market exists. It just gets very boring just saying asset and security, asset and security. Same thing with investing and trading. Most of us here today are because we want to learn about trading. We know the difference between investing and trading, but again, it gets very boring just saying trading, trading, trading. Now, it seems to be, whether I'm giving a webinar, a seminar, whether I'm at a conference, whether I'm meeting new traders somewhere, it seems like everybody wants to ask me, what should I buy today? Do you know how many calls I've gotten, how many people have stopped me, how many emails I've gotten? What price should I buy oil? Do you think oil is going to go back up? Do you think oil is going to go any lower? You know, wouldn't investing and trading be easy if I knew or you knew the answer to these simple questions? But I don't have a Ouija board and I don't have a crystal ball. And anybody who tells you they do is full of it. Trading is all about education, experience, knowledge, and risk management. And hopefully, technical analysis, which is what we're going to be discussing today, will help you make better trading decisions. Because the more you can read in a financial chart, the better you can understand how to find entry points, exit points, how to chart and understand what the market's telling you, and how to read price action. Now, before you freak out, technical analysis refers to the study of the financial markets based on price movement. It uses the assumption that the price of a share or an asset reflects all the information about that asset, including market sentiment, as well as perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for identification of well-known patterns that emerge in assets. For example, a head and shoulders, a channel, a triangle, or wedge. So before we get freaked out on the term technical analysis, I don't use the term, okay? Because it's interchangeable and too many people get very uncomfortable when you say technical analysis. So let's call it chart analysis, because basically everything and anything you do with technical analysis is done on a chart. Everything you do on a chart is part of chart analysis. So what are you doing? You're analyzing price by looking at charts. You're using all types of tools. Now, chart patterns are well documented in chart analysis literature and are based on a psychological phenomena that occur between the buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of the future trend of a share or an asset as it breaks key psychological barriers in the form of support and resistance levels. Okay, so that's a lot to absorb. So my belief in the markets is that price is completely random. It goes up and down, it goes sideways, it goes in and out, it does whatever it wants to do, because it's basically the value of an asset between a buyer and a seller, and it's all made up of human beings. But there are certain times that price exhibits non-random behavior. When we can find this non-random behavior in the markets, we can make rational trading decisions. Chart patterns will help us do that. So let me pop up a live chart here before you get bored silly. Okay. So what are we talking about when we talk about chart patterns? Well, we can also call it market structure. So on this chart right here, you can see there's all kinds of weird things people have out there. Okay, I saw one called the curvature today, where somebody came up with how you analyze the curve of a market movement. Okay, it might work for that person. I don't know anything about it. But as far as chart patterns, there are some chart patterns that have been around for 100 years that traders trade from, that are well respected, that work in every market and all the time. This curvature that somebody's talking out there might work this week or this month. There might be, something in their own head that works for them, but we don't understand it. But chart patterns are made up of things like double bottoms, bull flags, bull pennants, ascending wedges, descending wedges, triple tops, bear flags, bear pennants, the inverted head and shoulders, cup and handle, expanding wedge, cup and handle, and head and shoulders. Because remember, for everything one way, there's an opposite. So the inverted head and shoulders is the opposite of the head and shoulders. The inverted cup and saucer is the exact opposite of the head. Okay. Bear pennants and bull flags. Okay. But the most of them are triangles or versions of triangles. So we have what we call ascending triangles, descending triangles, and symmetrical triangles. What do we mean by this? Okay. And I just dump them all into triangle. A symmetrical triangle is like that. The top and the bottom support and resistance line are basically the same angle. An asymmetrical triangle and a symmetrical triangle are just the opposite, where one of the levels is horizontal and one is on an angle. But the only differentiation between that and a wedge is the angles on the support and resistance are slightly different. But ultimately, they form into what we could call a triangle. Even a bull pennant and a bear pennant are triangles. When we can see these appear on a chart, we can then, let me just get these markings off of here, we can then make some analysis. Because they appear in our trading over and over and over again. And they are easily decipherable because they do interpret what the buyers and sellers are saying. But a triangle basically shows you the price is being pushed into an apex. It's getting smaller and smaller, getting pushed into here. Now, the difference between the triangles is the the bullish characteristic. Whether you think price is going to break out upward or break out downward. Okay. Again, I don't worry about this. A triangle is a triangle. We can't tell what's going to happen until we get the breakout of the triangle. And it can break out upward or it could break out downward. But once it does break out, we can do some very smart things in the marketplace using those triangles. Okay, so notice these on charts is easy. Now, how do we do this and what will they tell us? That's a whole different story. But once we see them, we can then start understanding what price is trying to tell us, because price is starting to move in a non-random fashion, a fashion in which we can make some trading decisions. So there are numerous types of patterns, all named according to the shapes and the price graphs formed between the support and resistance lines. The general types of patterns include triangles, channels, wedges, and head and shoulders. So the three main triangles are symmetrical, ascending, and descending. And like I said, the difference is a symmetrical triangle, the support and resistance lines are on the same angular line, where an ascending has a horizontal line and a descending has a horizontal line. And it just depends on whether we have the price is moving up or the price is moving down. Now you can get an ascending triangle or a descending triangle in the opposite trends, but that rarely happens. But the nice thing is, once we see a chart pattern, especially a triangle form, we can make very astute observations And these hold true for historically forever. If you use them, they will help you. It will help you find the entry point, the exit point, give you the limit so that you can set the target point, so that you can set your risk management controls, and all of that based on the triangle. Because the formula is that the price move, when the price breaks out of the triangle, whether it's up or down, will be equal to the width of the base of the triangle. You can set your stop loss. If it breaks out upward, you can set your stop loss at the swing low right before the breakout, and you would set your take profit point here. Now, when would you enter the market? That's tricky. We can figure out the price will enter the market because we want to enter the market at the close of the candle that broke out of the pattern. But now what I teach is we would enter on the third candle because we want to make sure price doesn't go right back into the triangle pattern. So you would set your price at the close of the candle that broke out, wait for the confirmation candle, which is the next candle, and then open your position in that third candle. But that's a strategy, not an interpretation of the chart. Now, another thing that will help us is volume. We need to see volume contracting as price is moving towards the center of a chart pattern, and that when price breaks out, we should see an increase in volume. That's the kicker that lets you know that you have a true breakout. But then we have other patterns, like, and don't worry about, okay, first of all, you don't have to memorize everything I'm telling you. Okay, this number one is standard. Number two, if you look on your screen, there's a handout there called Chart Patterns, final handout. That will give you all the formulas and examples of each pattern and how you would set your entry point, your exit point. Now, that's only available in the live class. There's nothing you have to register for, nothing you have to pay for, nothing you have to do anything but click the download button and download it to whatever device you're using right now, and then you can move it around later. I've also put in the handouts the technical analysis guide from investing.com. This is an incredible resource guide. Again, no registration, it's free of charge. There's nothing you have to do. Download it, it's a PDF file, and use it at your convenience. It's a very, very good resource guide. But it will also go over all the different chart patterns, as well as all technical analysis. But they're only available in this live class, so you won't be able to access them in the recorded version or at a later time. Now, channels and rectangles occur quite often in our trading, and you should be aware of them, but they don't give us any validity for our type of trading because they happen so often. A channel is formed between parallel support and resistance lines. We could almost call it a double bottom and a double top, or sometimes we refer to it as, trading between support and resistance lines. But this pattern usually indicates a relatively strong trend up or down, with the price staying within the lines until the breakout. The breakout of a channel indicates either a reversal in the trend or a change in the slope of the current trend. And then we have up and down channels, but they're very much like the trend line, whether price is moving up or price is moving down. And a channel and a rectangle are basically the same. They're just different, slightly different angles, and they're formed between horizontal support and resistance lines. So rectangles and channels are sometimes referred to as flags and pennants, depending on the slope of the initial trend and the slope of the breakout. Now, flags and pennants get a little bit confusing only because they are basically either a channel or they're a triangle, but they have characteristics. So a flag would be defined as a bullish continuation channel down. Well, you know what? That's a whole bunch of hogwash, because I just lump them in because they are exactly what a triangle is. I just lump them in triangle because if you start getting involved in the characteristics and what they're supposed to be doing, you'll start making your trade based on what your assumption is. And when you do all the studies and calculations, the difference between the characteristic of a pattern and whether it will actually move in that direction and not moving is so close that we couldn't risk our trading. It's like the difference between 51% and 49%. It's right 51% of the time, wrong 49% of the time. That's just whether you should trade up or down. Because the only thing you can trade is the price action, the breakout of the pattern. And wedges are just like triangles, except wedges have the two lines moving on different angular slopes. But we interpret them all the same. Then we come to head and shoulders. Head and shoulders is a complex pattern. It is exactly what the title is. It's the head and shoulders of a human being. Now, a head and shoulders takes a while to develop, but when it does, and you find it on your charts, it is very meaningful. And what happens, you don't really notice the head and shoulders till almost the end of it. It doesn't matter. You don't need to realize it until it's over. But price moves up, hits and forms a new high. Price falls down and comes down to start forming what we call the neckline. It then rallies again, moving up and goes higher than the previous high, and then comes back down to hit that same neckline, which would be basically your support level. It then bounces off of there and comes back up to match that previous high over here. This is the formation of the shoulders. Now, my interpretation is you have all different kinds of people. Some people have sloped shoulders, some people have square shoulders, some people have even shoulders. You also have people who have long necklines and big heads, and short heads and long necklines, short squat heads. There's all types of people out there, gurus out there trying to tell you this shoulder and that shoulder must be within this range and the head must be in that range. Basically, as long as you have the formation of the shoulders and the head that's higher than those, the important part is the neckline. Now, this doesn't tell us anything at all until formation of the left shoulder, neckline, formation of the head, neckline, okay, formation of the right shoulder. It isn't until this point that we can even really start making some observation, because price could continue up here, okay? So until we get to this level, there's no sense of even getting ourselves ready. Okay, when price hits this level, and this is actually about the same time that you'll probably notice the pattern. When it breaks that neckline, it's time to enter the market in a short, because you're coming off of an uptrend, push, ease, push, ease, push. And when it breaks this neckline, it tells you that trend is over. You have the exact opposite for coming off of a downtrend. And the funny part is they really do work. The fact is, though, they're very, very difficult because seeing them sketched out here is very easy to see. Seeing them in real life is really quite complex. So that's what I'm saying. You probably wouldn't see it until it was almost finished being developed, because I don't ever see them. My eyes just don't catch them. Other people see them right off the bat, but it's hard to see them in the value of in everyday trading. But once you do, there's a set of formulas that we can apply that works quite well. Okay. The neckline, the headline. Hold on, let me just put some markings on here. So here we have the head, the top of the head. That's the price at the top of the head. We have the price at the bottom of the head. So to formulate everything is, first we want to set our target price, which is the target price would be equal to the neckline minus the head minus the neck. Okay. That's going to tell us where we would set our target for when this broke below the neckline. So we would take the sell position when it broke the neckline. We could then set our targets. Remember, we always have to set our risk management. And we can set our neckline here. You would take your stop loss at the swing high after the shoulder. I'm sorry, the swing high here of the shoulder. And so you have your stop loss, your entry point, which is the candle that broke the neckline, and your target point. So this is all you need to make a trading decision. You just do the reverse for the inverted head and shoulders. Now, before we go on here, I want to share with you a little presentation that'll give it to you in a little bit of a graphic format. And then we'll go on and talk about how we would apply the formulas to the other types of patterns, especially triangles.
The symmetrical triangle pattern is formed by two intersecting trend lines of similar slope. These two lines are converging at a point called apex. The coiling of price that happens inside the triangle will eventually result in a breakout. The breakout can occur in any direction and the move is often as big as the base of the triangle. The ascending triangle pattern is easily recognized by a rising trend line intersecting with a flat resistance line. It is often regarded by traders as a bullish pattern because the price keeps bouncing off a resistance line that may eventually be broken. That descending triangle pattern is formed by a descending trend line intersecting with a flat support level. The repeated attempts of the sellers to push the price down can result in a breakdown through the support line. In all cases, the stop loss can be placed beyond the opposite trend line. The stop loss distance can be at least as big as the distance between the trend lines, measured at the moment of the breakout. A good place to place the take profit level is considered to be as far from the breakout point as the triangle base is wide. Choosing the take profit distance a little smaller than the base width, if the risk-reward ratio allows it, can increase the chances of price reaching it. These chart patterns have no predictive properties, but they may give hints about the forces involved in the market.
So that sums it up pretty much on a triangle. Then we come to double tops and double bottoms, which is something you hear about quite often in the marketplace. Again, I mentioned earlier when we were looking at channels and rectangles, there's a rectangle is basically a double top or double bottom that I pay very little attention to because in our type of trading, and especially in short-term charts, they appear quite often. And it means the price moved up, touched a resistance line, came back down to a support line, bounced up, back up, went to that resistance line, and then comes back and breaks through that support line. Okay. But when it happens just twice, it's not valid enough for me. It's not unusual enough that it's going to make me make a trading decision. But from here we go to the next step, which is triple tops and triple bottoms. Now I might pay attention because triple tops mean it's touched the support or the resistance line 3 times. And that number that is touching, it's got to be pretty precise. If the euro is trading at hits a high of 103.42, well, yeah, if it hits a high again when it bounces back up 103.40 and then another 103.43, that's acceptable. But you can't just estimate, so it went to 103.29 and then 103.42. You need it to be pretty consistent, bouncing off of those support and resistance lines. And you can actually trade those bounces consecutively, because sometimes when the markets are moving sideways, you can get a lot of trade. But we have a very simple formula for this, is how to calculate your target is support minus the height of the pattern. Well, that's the same as, okay, support and resistance, because where would you set your target? I would set my target at the below resistance level. But triple bottoms and triple tops are pretty reliable indicators when you see them in a chart pattern. Now, the most important part, whether you're going to trade head and shoulders, whether you're trading triangles, inverted, cups and saucers, whether you're trading pennants and wedges and flags, is understanding that the quality of the pattern is based on the quality of the trend. Not whether it's an uptrend or a downtrend, not whether it's an ascending trend, descending trend. But price can move in very well-defined, or what I call non-random movement. It's when you're getting a very nice trend and a pattern develops. When a pattern develops in a nice trending market, that pattern becomes more reliable. When you have a weak market where price still was moving up, but it's not in a well-defined market, okay, the pattern still can hold, but it's going to have less validity. You need to put less in it. The more the trend is developed, or the more a trend is an actual pattern of non-random movement. So the less randomness that's in the marketplace, the more that pattern will be valid. Now, it's important to remember that you need other supporting factors. So you just don't jump in the markets when something breaks out of a pattern. First of all, the first confirmation should always, always, always be volume. You should also always wait for a second confirmation candle, because price can jump out of that pattern and move right back into that pattern. But if volume doesn't support your breakout, then perhaps you have a false breakout. So the pattern is said to have broken out once it's crossed either the support or the resistance line. If the pattern broke out of in the same direction of the preceding trend, it's called a continuation pattern. If the breakout is in the opposite direction, it's called a reversal pattern. For example, a pattern described as a bullish reversal triangle would mean that it's a bullish signal, that is, the breakout through the resistance line upward. Because it's a reversal pattern, that means that the preceding trend was in the opposite direction of the breakout. Now, that was a mouthful. Okay. But what it's telling you is that the preceding trend was up and you had a breakout going down, so you have a reversal. But you can make it that very easy language and don't have to overcomplicate it saying, well, I see a bullish reversal triangle. But some people do. I would just like to say I see a triangle, an ascending triangle coming out of that's coming off of a downtrend. Now, how do we use these to set our trades? Okay, these are standard industry acceptable values, okay, or formulas. So you see, you would, whether we have a falling wedge, a bullish rectangle, a bearish pennant, we would use the width or the base of our pattern. And the base of the pattern was a triangle or a wedge or a channel, is when both the support and resistance lines are in play. Okay, so it's the difference of this move. That would set our target point. Our entry point would be after the breakout, and our stop loss would be either at the channel or the last swing low before the breakout. So in other words, here in a bullish rectangle, the difference here is our target point, stop loss slightly below our support line, enter when it's above our resistance level, when it's broken out of the pattern. Same thing here. And you find that these actually do work, but you need that confirmation of volume. And then there's one other kicker. You need to be looking at your support and resistance levels above and below the pattern, because if your target point is above the next support or next resistance line, you have to then adjust your target to be below that next resistance level, because there's a good chance it's not going to go through that farther resistance level. So if your difference here was up here, but you had a serious resistance level here, you need to use that to set your risk management points. Let me take you over to a live chart and see if I can show it to you there. So in other words, this is the width of our pattern. If we had a breakout upward, we would then set our width to the equal distance of that breakout. So let's say hypothetically it was here. Okay. if we had this resistance level in between, we'd have to change this level here to be that level, and then use that for our calculation for our risk management. But you see here, we actually had a breakout. We had a beautiful triangle. We had a break above, but it ended up being a very false pattern. And that's why we needed that third candle to make our trade, because it actually moved right back in and you would have never gotten an entry level. Now, again, here we had the beautiful triangle. We got the breakout candle here. We had our confirmation candle. We'd enter the market here at our buys price, and we would have set our resistance level up here, and we would have taken that trade, and we would have done quite well in that trade. Our stop loss would have been below the breakout, below the swing low of the before the break. So even though we got this low falling candle here, it stayed above where our stop loss would have been. So we would have stayed in the market, and we would have ended up here and then here. Now, all of this is explained to you in those handouts that I gave you. So please refer to them and use them as your guide. And let's go back to my PowerPoint here. Hold on 1 second. And always remember, you need to see where support and resistance are. You need to see volume. You need to wait for a third candle confirmation. And then you can go ahead and use these patterns or incorporate these patterns in your trading decisions. So thank you very much for joining us. I hope everybody's doing well through this trying period. And I hope to see you in more of our classes. Have a great day now. And again, if you have any questions, go to www.legacyfx.com, click on the chat button, or send them an email, and they'll arrange for a one-on-one conversation with you, a financial analyst, who will answer all of your questions on a one-to-one basis. So again, thank you very much for being with us, and have a great trading week. Bye now.